You're watching Money, Money, Money. I'm Sumaira Abdi. The Reserve Bank has cut the repo rate, or the rate at which the RBI lends to commercial banks, by 0.25%, and the Reserve Bank governor has reiterated his call that banks pass on the benefits to consumers. So what followed was that one by one, most banks undertook cuts in their base rates almost simultaneously. So what does this mean for an average loan consumer like you and me? What exactly are the benefits that we derive? Are there benefits at all in waiting for a rate cut? Harsh Roomta of apnapesa.com joins in this week to answer this and many more such questions. Harsh, thanks very much for coming back on the show. It's always a pleasure to speak with you, and this is such an interesting topic because since the rate cut started, there have now been 75 basis points of repo rate cuts by the RBI. Transmission, you knew, has been few and far between, and even the kind of cuts that banks have taken in their base rate is very, very negligible in most cases, at least the biggest banks. Is it really worth waiting for an average consumer for a rate cut? I mean, should I actually delay my purchase of a home loan to get this few basis points of a rate cut in the lending rate?
See, theoretically, when you're taking a home loan, and 99% people take a floating rate home loan, it should not matter when you take it. Simply because even if the rate is high currently, okay, as the rates drop in the future, if they really pass it on to you, you will benefit. Okay, so theoretically speaking, there is no point in waiting unless you have a issue in affordability, because when EMIs fall, the amount of loan that you can get can increase.
I notice that you keep saying theoretically. What's in between the lines? That's what you want to know.
So in between the lines, I think it is pretty well known, including the Reserve Bank governor, who's complained, various committees of RBI, various other committees, is very, very clear that when market interest rates go down, the banks don't pass on the benefit to the floating rate consumers. On the other hand, when market interest rates go up, they immediately pass it on to all the existing consumers. So I think that is what I meant by theoretically. In an ideal world, when market interest rates went down, every existing consumer should get the benefit, but he rarely does, and that's an acknowledged fact.
So is it then not to your advantage to take a loan on a floating rate?
That kind of a thing would have been okay provided you had a good fixed rate option. Now typically in India, very, very few fixed rates are available that is fixed rate for the whole period. They will typically be fixed for 2 years, 3 years, 5 years, and then again you are exposed to the vagaries of a floating rate one. Two, the premium that you are charged. I mean, today if you go for a fixed rate, say even a 5-year fixed rate contract, that will come to you at 11.25 or 11.5 versus the 9.9 or 10% that you get on a floating rate. So I mean, that really is not an option.
So if I'm looking to take a loan today, what sort of a bank should I be going to? Is this more prevalent in public sector banks, or is this more prevalent in private sector banks?
So I think this is general perception that the public sector banks are fairer than their private sector counterparts. That's not borne out by data. I think as far as not passing on the benefits of floating rate loans on the downward side is concerned, all banks or all housing finance companies, all of them are on completely equal footing. We've done this study over long periods of time. A small little segment we've shared with you for the period between January 2011 and April 2015. And as you can see from this study, between borrowers of ICICI, HDFC and SBI, new consumers at a given point got exactly the same rate. 9.5% in January 2011, 9.9% in April 2011. But the people who took loans at 9.5% in Jan 2011, if they didn't shift, in this particular instance, the SBI customer is worse off than the ICICI and HDFC customer as on April 30th. This position may change a little bit, but I think what the study emphasizes is that there is no difference between a public sector bank or a private sector bank or a housing finance company as far as the past is concerned in terms of treating customers, past existing customers unfairly.
Okay. And you mentioned housing finance companies as well. I mean, they're the real giants in this place, you know. Would their customers really be at such a big disadvantage? Or, you know, is it like, say, the bigger banks? Bigger bank, bigger disadvantage? Would the smaller banks be easier then?
So I think that this question needs to be answered in two parts. One is what has happened in the past. And I think after the base rate mechanism has come in, I think the banks have been forced to be relatively fairer than the housing finance companies, and now currently almost all banks are lending at very close to their base rates. Whenever they want to reduce rates, when markets force them to reduce rates, they will now have to reduce base rates. They really will have no choice but to reduce base rates, which means that if you're now taking a loan from any bank, private sector, public sector, because you're very close, because you are at the base rate or very close to the base rate, the chance of a discrimination in the future is that much lower or non-existent. The base rate concept or a minimum rate concept does not affect the housing finance companies because home loans is the only thing that they do. So because of that, I think going forward, people who borrow from housing finance companies are going to be at a disadvantage very clearly.
But don't you think the fear that they may lose market share would force them to match step with the banks?
So what you're saying is that for the new consumers, they've always matched rates. Competition hasn't.
But nothing stops me from shifting my loan from A to B.
Exactly. I think the regulators, both the regulators, RBI and NHB, instead of enforcing, both have regulations that you can't differentiate between an old consumer and a new, both of them. Okay, they don't enforce these regulations. Neither NHB enforces those regulations, nor the RBI enforces those regulations. Both of them are very satisfied by saying you can't charge a prepayment charge, and they are assuming that competition will take care. I think there are two big issues with this. The first big issue is that a lot of home loan consumers, 50-60% probably, are not even aware of what rates they are paying, because the EMI remains the same. Even when your rate goes up, your EMI remains the same. Second, even for the more aware consumers, and I think media has played a huge role in making consumers aware, the non-financial barriers. So the financial barrier of a prepayment charge has been abolished, but the process has deliberately been made very cumbersome.
That's a good point actually you raised, and I want to come back to it later in the show and talk about this a little bit more. But coming back to this whole our initial topic of the base rate cuts, Dr. Rajan also spoke about the change in the base rate mechanism. Could that be of some help and sort of alleviate this problem to some extent?
So I think there is this debate that has been going on, that the base rate mechanism measures, typically in most cases the banks are measuring their average cost, and obviously average cost takes time before it will react, because the new fixed deposit rates etc. Takes time to have an impact on the average cost. As the new deposits become a larger and a larger percentage of the overall deposit mix, it starts to have an impact. It will always take time. I think the thing that the RBI governor is saying is that maybe in that structure they will ask banks to do it based on the marginal rate. I think it has its own set of problems, which is the reason they are not doing it immediately. But the main issue still remains transparency, whether it is marginal or whether it is average.
Fair enough. All right. So on that note, we actually need to take a very quick break. But when we come back, we're going to tackle some more topics. Existing borrower versus a new borrower. Who's at a disadvantage? Are you even at a disadvantage? What should you do? All of that is lined up next. So do stay tuned to Money, Money, Money. News.